At the beginning of the year, I did a webinar where I spoke on, the topic of why having a fundraise partner is a must-have for any early stage startup. And I broke down the different types of funding stages and when you would need to go for which type of funding. So when funders come to us, they usually have an amount of, capital that they want to raise. And in this video, I'd like to break down the 3 must-haves and must-knows of fundraising. So if you're new to the channel, hey, my name is Denise Edwards. I'm the founder of SaaSlaunch.io, where we help early stage tech startup founders raise their pre-seed to Series A. So in this episode, I'll break down the 3 questions every founder needs to know and understand when it comes to raising funds. So the first question is, what are the different stages and how would you know in which stage you would fall with regards to raising capital? The second question is, what type of investors could you approach in that stage? And number 3 is, how much would you give away equity-wise per stage? So let's have a look at this graph right here. And us as a company, we focus on, helping early stage startup founders with funding, looking at the pre-seed, seed, and Series A. And in this graph here, you can see that it's broken down into 5 metrics. So metric 1 is, what focus is each stage. Number 2 is the source of where you can get your capital from, the amount you can raise, the metrics that investors look for when investing, and number 5 is dilution. So let's begin. So if you look at the pre-seed stage, this is usually the stage where founders have, an idea, they've worked it out, this idea, and would like to get funding to get to the next step, which is building a minimum viable product or MVP. And when we look at the sources of who would be an ideal investor, most likely this could be, family or friends. You could bootstrap your company, you could look at angel investors or some type of incubator program. Now you also have pre-seed firms that, invest in the ideation phase, but from our experience, these firms have, strict guidelines and prerequisites for the startup to get funding. You also have incubator programs, which is a program or a facility that provides, support, resources, and guidance to early stage startups and to help them grow and succeed. And, incubators are typically run by organizations such as universities, government agencies, or private companies. And it offers a range of services such as, mentorship, office space, networking opportunities, and access to funding. And the goal of an incubator is to provide startups with the tools and resources they need to develop their business ideas and bring their products and services to the market. Now, when it comes to the amount you can raise in a pre-seed stage, this differs per country and region that you're in. So if you would compare Europe, for example, against the US, European investors are a bit more conservative than US investors from our experience. And again, it can vary greatly depending on a number of factors such as, the industry, the stage of the startup, the location, and specific investors involved. In Europe, pre-seed investments amounts tend to be smaller than, for example, in the US. So according to data from dealroom.co, the average pre-seed investment in Europe in 2020 was 570K USD. However, this can vary greatly, again, depending on the location, with some countries offering smaller investments and others offering larger ones. So for example, the average pre-seed investment in the UK in 2020 was 1.1 million USD, while in Germany this was 485K USD. In the US, pre-seed investments amounts are generally larger than in Europe. And for example, according to PitchBook data, the average pre-seed investment in the US in 2020 was 1.4 million USD. However, as with Europe, this can vary greatly depending on location and other factors. So, for example, in Silicon Valley, pre-seed investments can range between 500K to 2 million USD or more, depending on the startup and the investors involved. And when it comes to, for example, understanding what the reasons are that investors, in this case, family and friends, are incubators, invest in the idea, they look at, the commitment of the founders in the company. That's one of the factors that they look at. Dilution in fundraising, equity refers to, for example, the reduction in the ownership percentage of existing shareholders as new shares are issued to investors in exchange for funding. So dilution can have a significant impact on the ownership and control of a company, particularly for early stage startups. As more rounds of funding are raised in the next rounds and new shares are issued, the ownership percentage of the founders and early stage investors can be greatly reduced. And in some cases, this can lead to a loss of control over the direction of the company. So when it comes to dilution in a pre-seed round, it can vary greatly depending on a number of factors, including, the industry, the stage of the startup, the location, and the investors involved. And it's generally expected that pre-seed rounds will result in higher levels of dilution compared to later stage funding rounds due to, of course, the higher risk involved in investing in early stage startups. So, according to a report by Crunchbase, the average dilution in pre-seed rounds in the US is around 15 to 20%. However, this can vary widely depending on specific circumstances of, the fundraising round. So, for example, some pre-seed rounds may involve convertible notes or safe, simple agreements for future equity, which can result in deferred valuation and a higher dilution rate upon conversion to equity. And additionally, the valuation of the company at the time of the pre-seed round can greatly impact the level of dilution, obviously with higher valuations generally resulting in lower dilution rates. And it's of course important to note that dilution is not the only consideration in pre-seed fundraising rounds. Startups and investors must also consider the overall amount of funding raised and the terms of the investment, and of course the potential impact on the ownership and control of the company. So while dilution can impact the ownership percentage of existing shareholders, it can also bring invaluable resources and expertise that can help the company grow and succeed, of course, in the long term. Now, looking at the seed stage, this is where things get a little bit more serious, as this is where the focus lies on having a minimum viable product in place and finding, obviously, product market fit. Having a minimum viable product, or MVP, is a basic version of a product that is developed with the minimum set of features required to satisfy early customers and of course to obtain feedback for future product development. And product market fit means that the point at which a company's product or service meets a strong demand in the market, resulting in a sustainable and scalable business. So in other words, it's the stage at which a startup has created a product, that solves a real problem or meets a genuine need in the market, and there is a significant and growing demand for that product. But achieving product market fit is a critical milestone, as it obviously signals that there's a viable market for the product and a pathway to sustainable growth and profitability. It typically involves a deep understanding of, the customer needs and preferences and an ability to deliver a product that meets those needs in a way that is better than existing alternatives. So if you look at where you can get investment from as a founder, these could include, for example, angel investors, family offices, micro VCs. If you look at angel investors, these are typically individuals who invest their personal funds into early stage startups, typically in exchange for an ownership stake in the company. And they are typically high net worth individuals who are looking to invest in promising startups that have the potential for high growth and significant returns. Family offices, for example, are private wealth management firms that manage the investments and financial affairs of high net worth families or individuals. And these offices are typically established to manage, the personal wealth of the family members, and they can be involved in a wide range of investment activities, including technology investments, for example. And they can invest directly in startups, either alone or as part of a syndicate, or they can invest in venture capital funds that focus on technology investments. And some family offices may also provide support and resources beyond funding, such as, mentorship, access to industry experts, and strategic advice, and they are often able to make more patient and long-term investments in startups than traditional venture capital firms, as they are not subject to, the same pressures to generate returns over a fixed time frame. And this can make them an attractive source of funding for startups that are, looking to build a sustainable and profitable business over the long term. Now, looking at micro venture capital firms, so micro VCs, these are investment firms that provide seed stage and early stage funding to startups, typically with smaller investment amounts than, for example, traditional VC firms. And micro VCs typically have a fund size of less than 100 million, which allows them to make smaller investments in startups that may be overlooked by, larger VC firms. And they can also play an important role in promoting diversity and inclusivity in the tech ecosystem. They often invest in startups led by underrepresented founders, including women and people of color, and who may have difficulty accessing funding from, traditional VC firms. Now, when it comes to the amount you can raise in the seed stage, this depends, again, greatly on factors such as the industry, geographic location, and the specific needs of the startup. And according to PitchBook's 2020 Global Venture Report, the average seed stage deal size in Europe was 2.1 million USD, while in the US it was 2.7 million USD. And in general, seed stage funding rounds tend to range from around 500K to 2 million USD. And the amount of funding raised in the seed stage can also be influenced by factors such as startups industry, market potential, and competitive landscape. And it's worth noting that the funding landscape for seed stage startups can vary depending on the location. For example, startups in Silicon Valley may be able to raise larger amounts of funding in the seed stage due to the presence of a large number of VC firms and angel investors with experience in the tech industry. And in other regions or countries, the availability and amount of seed stage funding may be more limited. Now, metrics that investors look at this stage of the raise. So investors are looking for, early evidence that a startup has identified a clear market opportunity, has developed a strong product, and has a plan for scaling and achieving profitability. And what they also want to see is, a strong founding team with the ability to execute on the plan and of course manage the startup's growth effectively. And a typical dilution percentage in the seed stage of fundraising can range from around 10 to 25% with an average dilution percentage of around 15%. However, this can again vary widely depending on the specific circumstances of each fundraising round. Now, when it comes to Series A, startups are often looking to raise larger amounts of capital, basically to support their growth and expansion plans. So in exchange for this investment, investors typically receive an equity in the startup, and these funding rounds typically involve institutional investors such as VCs, venture capital firms. Startups at this stage may also attract interest from strategic investors such as corporate venture capital arms or other companies in their industry. And Series A rounds are typically used by startups to scale their operations and expand into new markets. And at this stage, the startup will, have already developed a working prototype, established a customer base, and demonstrated traction in its market. And as a result, Series A investors will be looking for evidence of strong product market fit, a scalable business model, and a team with the expertise and experience to execute on their growth plans. And this is the stage where, you as a founder can implement an ESOP, which is an employee stock option plan, which is a program that allows employees of a startup to, purchase company shares at a discounted price or through an equity-based compensation package. And during a Series A round, it's common for a startup to create or expand on its ESOP program. So this allows a startup to, attract and retain top talent by, offering equity incentives to employees while also conserving cash for other business needs. So implementing an ESOP during the Series A funding round can also provide, additional benefits to the startup, such as helping to attract and retain top talent, providing a competitive advantage in the hiring market, and aligning employee incentives with, the long-term success of the company. And finances are usually raised through VCs or other venture capital firms and investment firms that provide capital to startups in compensation for an equity stake. So VC firms are typically managed by a team of investment professionals who specialize in identifying and investing in promising startups. So when it comes to the amounts raised in Europe, Series A funds basically typically range from 5 million to 50 million euros with an average size of 7 to 10 million. However, funding rounds up to 20 million are becoming increasingly common in some European markets, particularly in the UK and Germany. For example, in the US, Series A funding rounds typically range from 5 million to 20 million with an average size of around 10 to 15 million. However, funding rounds of up to 30 million or more are not uncommon for particularly promising startups in high-growth industries. And according to PitchBook, a leading data provider for private equity and venture capital, the average Series A deal size in Europe in 2020 was 11.6 million euros, which is approximately 13.7 million USD. However, it's important to note that this figure can vary widely depending on factors such as, the industry, geography, and the stage and the needs of the startup. In the US, according to the National Venture Capital Association, NVCA, the average Series A round in 2020 was 15.6 million USD. And again, this can vary depending on the specific of each deal size. And metrics that are looked at by the investors typically include, in this stage, monthly recurring revenue or MRR, and this is a key metric for SaaS and subscription-based businesses. And investors will want to see consistent growth in MRR and a clear plan for, how the company will continue to acquire and retain customers. Another metric is customer acquisition cost or CAC. Investors want to see that the company is acquiring customers efficiently and cost effectively, and a high CAC can be a red flag as it may, indicate that the company will struggle to achieve profitability or sustain growth. And another factor or metric is lifetime value of a customer, LTV, which is the total amount of a revenue a company can expect to earn from a single customer over their lifetime. And a high LTV relative to CAC is a good sign that, the company has a strong product and a loyal customer base. And at a Series A, it's common that, the ownership percentage of the founders and existing shareholders of the company may be diluted by 15 to 25% to accommodate the new investment. So overall, when it comes to seed and early stage fundraising, do take into account where you are in your process of building your solution and which investment option would be best for you. So don't get diluted too much at the start. Specifically, a rule of thumb is to have 50 to 60% of your equity in the company by the time you finish your Series A. So do let me know in the comments if you have any questions on this, and I'd love to know how has the raise been for you.